How's it going? It's Russell here, and in a rare move, the Governor of the Bank of Canada wrote an article that speaks directly to Canadians, and he has a message that has some bad news and also has some good news that will largely affect the lower to middle class income level of Canadians. So today we're going to talk about exactly what this message is, as well as what Trudeau has to say about it and what it means for you. But before we do, if you're not already, make sure that you're subscribed down below and click that like button because it helps more Canadians get this information in their YouTube feeds. So here's the article written by the Governor of the Bank of Canada, Tiff Macklem, and I'm going to break down the most important parts for you here. The main thing here is he's saying inflation in Canada has actually come down a little. He feels good about that. The fact that we're at 7.6 now, the most recent reading from a few days ago, when in June we were at 8.1, and he thinks that this is good news because it seems that inflation might have peaked. It might have reached its highest point and be downhill from here. So that's the good news that he's saying. But even though he thinks inflation has reached its peak, it looks like he doesn't think it's going to go down very quickly, saying that inflation is likely to remain high for some time, a lot different from when he was saying it was transitory or very short-lived in the past. Now, at the Bank of Canada, they want to bring inflation down by changing interest rates. So it seems that at this next sort of interest rate hike period, it seems that they're going to raise it from 2.5% to 3.5%, likely. Another 1 point raise. We could see a 0.75% raise to the Bank of Canada's interest rate, which has a big effect on Canadians, particularly the lower and middle class. You see, because inflation is so high, the Bank of Canada wants to raise interest rates to make it more expensive to borrow money. People believe that by doing this, you'll reduce demand for goods, which means that the prices will stabilize and we'll sort of see inflation go down. But that does hurt the people who are most struggling from inflation in the first place, because as the cost of living goes up, also it becomes harder to get a job because interest rates are higher. It becomes harder to borrow money, less affordable to purchase a house, even though housing prices are down. People are paying more in their interest rates for these houses, so housing is even less affordable. So some people will say, okay, well, why are you even doing this if it's making it worse for the people you're trying to help? And he has a response. Let's look at this. He says, we recognize that for many Canadians, higher interest rates will add to the difficulties they're already facing with high inflation, but it's by raising the borrowing costs in the short term that we'll be able to bring inflation down for the long term, and that this will ultimately be better for everyone because high inflation hurts us all, eats away at our purchasing power, and makes it difficult to plan our spending and saving decisions. It feels unfair, and that erodes confidence in our economy. Again, this is mostly going to affect the very people that were struggling with the high cost of living as a result of all of the money printing and the high inflation that we've seen over the past year and a half, 2 years. Now, in a past video, I've gone into way more depth about what exactly the Bank of Canada is thinking when they're doing this and why they actually would want to keep wage prices down intentionally to help them out with this situation. If you're interested in learning more about that, check out the video. I'll pin it right there so you can click on it after you're finished this video. Of course, inflation is a huge issue, largely because most jobs in Canada won't keep up with the pace of inflation. Even very strong unionized jobs are having trouble doing this right now. Look at what the president of Unifor, the largest union in Canada, had to say, that average wages in Canada are rising at more than 5% a year, but workers' purchasing power is still declining because of the highest inflation seen since the 1980s. If you have a 5% income raise and inflation is at 7.9%, even if that's down from the previous month, it means that you actually got a demotion in terms of payment, not a raise, even if you got a 5% a year increase to your wage. And while Unifor has been able to secure a 25% wage increase for some of the people that they represent, largely certain sectors of casino workers, most of the people that they represent don't actually have any kind of inflation baked into their contracts. Take a look at this. Back in the 1970s, late 1970s to early 1980s, around 30% of workers in the union were able to get increases to their wage based on the cost of living increases. But now we're seeing that is more close to 5% of union members, and this is even in unionized jobs. Most jobs aren't unionized, and most jobs won't have any kind of inflation control baked into their pay structure. Meanwhile, in the public sector, where people are paid by the government, they're actually asking for a 4.5% pay increase, the largest public sector union, which is, mind you, still below inflation. But even though they're only asking for something that's below inflation for an increase, it seems that Trudeau and his government aren't budging on this issue. Instead, Trudeau's response to the inflation dilemma takes a little bit of a different approach. Let me show you a clip from a rare appearance on a very casual podcast that Justin Trudeau did back in June.
Like, we actually have really leaned in to try and support people through it, because that's where people are going to sit. Right now, inflation is the biggest challenge. And yes, intellectually, people will say, yes, we need more gender equality. We need better fight against climate change. But as we're seeing with gas prices right now, as soon as inflation or gas prices go high, people are like, oh, no, we need more oil and gas. Oh, I thought you were an environmentalist. Yeah, but I'm paying huge. I can't afford to fill my tank anymore. Goes, yes, but we got to get beyond that. So you have to bring people along where they are. That's why our answer to inflation, for example, is what we fought on in the last election, which was $10 a day childcare right across the country. And that's one of those things that we actually are delivering right now that means, yes, better opportunities for kids, lower costs for families, but mostly we're bringing more women into the workforce. We're making sure that people actually have choices between kids and not have to make a choice between kids and careers. Yeah. And that kind of policy, which, yes, is a progressive policy to make sure you're making a childcare affordable, and Conservatives fought against us in that election. But it's actually fundamentally economic policy. And the more you can tie progressive policies to things that actually matter in people's daily lives, the more you bring them back into a reasonable place in democracy.
So Trudeau tees up his childcare plan as the answer to inflation that his Liberal government has come up with here. And I think that there are a couple problems here. And in fact, there's actually been an article that has been posted about this rather recently, but I'll give you my take about why this doesn't make the most sense. Now, I have one main reason, but a first reason is that, hey, well, when they were actually crafting this $10 a day childcare program, that was back in early 2021. Actually, maybe it was even in late 2020 when inflation wasn't a problem at all and we were well within the 1% to 3% inflation area that the Bank of Canada says is normal. The main reason that I think this doesn't make a lot of sense as the main thing that the Liberal government is doing to combat inflation is the fact that childcare is not a very large portion of the CPI. If you've been watching the channel for a while, you'll know that CPI is the Consumer Price Index, or the sort of percentage that we use to track the cost of living here in Canada. It's made up of a bunch of different items. Take a look at this. It looks complex here, but we're just going to hone in on one thing, which is the household operations, furnishings, and equipment. This is the area that childcare is actually held under, and it's actually held under other household goods and services. Now, if we take a look over here, we can see the percent, and that makes up 5.21% of the CPI, which is other household goods and services, of which childcare is included inside. So only 5% for that entire subcategory. And when we take a look at that other subcategory where childcare services is held, there's also a number of other things included in here: housekeeping services, cleaning products, paper, plastic, and aluminum foil supplies, pet food, a bunch of other things that are included in that 5%. So this is what leads me to believe that childcare is rather negligible when it comes to the overall inflation picture, for which we use the CPI as our main indicator. So despite this rather lackluster policy for tackling inflation, what's my whole take on this letter from Tiff Macklem, the governor of the Bank of Canada? Well, in the short term, I believe this means that there's likely to be, again, another interest rate rise in the near future. I believe they meet in September. They could put that up 0.75% or even a full 1% raise like they did at the last meeting. And this could mean that it could be harder to get a job for the next little while. When interest rates go up, we see less spending by businesses. They sort of tend to trim the fat and fire people that they don't actually need as part of their business. So it could be a tighter labor market. In terms of investing based on all of this news, I think it's far better to dollar cost average into the market or slowly put your funds into your investment of choice over time, rather than trying to time the exact right point when we think the economy is going to make a rebound here. Most of the time, the vast majority of the growth that we see in these markets happens on individual days that nobody can specifically predict. So if you're slowly funneling your money in over time, you're going to get an average of all of those increases and all of those declines, and you're not not going to be kicking yourself for putting a bunch of money in and then the economy worsens and so do your investments. But in the end, I also want to say that whenever you hear something from the Bank of Canada, you kind of have to take it with a grain of salt. We saw even just 1 year ago, Tiff Macklem, again, the governor of the Bank of Canada, did a similar sort of mechanism here where he wrote a letter to all Canadians explaining his position from almost exactly a year ago in July of 2021. And the message was quite different. You might remember then he was saying, oh, inflation will only be transitory. We believe that this is going to be gone in the short term, saying a lot of interesting things. And that's what I want to leave you with today at the end of today's video is a minute or so from a clip of me covering this very same letter from a year ago and see if you can point out any things that sound a little bit fishy given our retrospect that we can sort of look back on those messages with. Take a listen and I'll see you in the next video.
So he's saying because we had low inflation at the beginning of the pandemic, that's why we're seeing high inflation technically in the numbers right now. And then he adds on some other things like gas prices. Remember, we had low gas prices at the beginning of the pandemic, and now we have them higher. So he's saying, hey, that's factoring into the CPI data that we're seeing now. That's historically high. And then he also mentions that because of different supply chain bottlenecks and difficulties in shipping and production of goods, we've also seen a sort of temporary, in Tiff Macklem's eyes, reduction of our ability to actually purchase the things we want, causing price spikes. But then he goes into a part where he's trying to sort of reassure Canadians that the Bank of Canada has their back, saying that they're going to keep inflation low, stable, and predictable, even with the gyrations caused by the pandemic. Inflation has been pretty close to target through the past few years to today, and you can be confident that they're going to keep the cost of living under control, and saying that they remain just as determined to secure a complete recovery and keep inflation under control.